Will investing in the Tata AIA life insurance value income plan help you achieve your financial goals in the long run? Let us find out through an in-depth analysis in this video. Hi there, welcome to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So, this is an individual, non-linked, participating life insurance savings plan. Some of the key features of the policy are there are two plan options: endowment or endowment with extended life cover till the age of 100. You also have the option to receive your cash bonus or to let it accumulate every year to receive it on maturity. A cash bonus can be received either on the policy anniversary or on birthdays following the second policy anniversary. And you have the flexibility to choose your premium paying term and policy term. The policy cover can also be enhanced through optional riders. So these are some of the key features of the policy. And there are also benefits like survival benefit, maturity benefit, and death benefit, which will differ based on the bonuses you get and stuff like that. So if you want to know more about these aspects of the policy in detail, you can refer to the policy brochure. Now let's take a look at the advantages and disadvantages of investing in this policy. So let's start with the advantages. The advantages are you will have the flexibility in choosing your premium paying frequency, which can be annual, half-yearly, quarterly, or monthly. And there are two options to choose from: endowment and endowment with an extended life cover of 100 years. And you can also choose between taking a cash bonus or letting the amount accumulate till maturity for a lump sum payout. And there is also cash bonus which starts from the second policy anniversary and continues till maturity. A cash bonus can be received on birthdays following the second policy year, and to meet any emergency, a loan facility is also available. And the riders in this policy will help enhance the cover, and there are tax benefits as per Section 80C and Section 1010D of the Income Tax Act. Now, the disadvantages are all the cash bonus and terminal bonus or non-guaranteed benefits. So these bonuses are not uniform all throughout the policy year. The survival benefit may also not be sufficient to meet your financial goals. And the lock-in period in this policy is 1 year for loan and surrender. The sum assured can be changed post inception of the policy. The sum assured is too low in case of death of the policyholder. The death benefit may also not be sufficient to meet any of your future family goals of your family in case of your absence. Now, as we have a basic understanding of this policy, let us move on to the analysis part of the video, where to make an informed decision, we are going to calculate the IRR, internal rate of return of this policy based on the benefit illustration given in the policy brochure. So just for calculation purpose, let us assume that a policyholder aged 40 years has purchased this policy, who is male, and he has purchased this policy for a policy term of 20 years and a premium paying term of 10 years, and he has opted for the option 1, endowment with accumulated cash bonus. Here his annualized premium is 1 lakh, basic sum assured is 9,52,381 rupees. So here the calculated return or just assumed returns are not guaranteed returns. The returns from this policy are solely dependent on its actual future investment performance. So based on that, the IRR is 5.66%. So from analyzing the IRR, it is clear that this policy does not provide an inflation beating return, and it provides which are some similar to savings bank account interest or FD interest rate, but it does not give you an inflation beating return. Now, if you compare this IRR to an alternative strategy where we are going to invest in insurance and investments separately. For example, we have opted for a pure term life insurance policy for life cover where the sum assured is 11 lakh but the premium is approximately 11,800 rupees. So compared to the annual premium of 1 lakh, here we are only paying 11,800. So the balance amount of 82,200 rupees can be invested in other other investment products for corpus accumulation. So if you are an investor who's not willing to take a lot of risk and who prefers safety and stability first, then you can choose to invest in PPF as an investment choice. This is a tax-free, low-risk product which is a government-backed scheme. So as an investment choice, what we need to understand about PPF is this: here we have to pay a minimum of 15 years. So in order to have a similar cash outflow of 10 years as in the Tata policies example, we have assumed to pay 500 rupees, which is the minimum investment amount of PPF in the 11th to 15th year to keep the investment going. So here this is deducted from the 10th year contribution. So if you are a risk tolerant investor who has good knowledge about market related product and you're willing to take a lot of risk, then you can choose an option which involves equity. So here we have opted for an equity linked savings scheme, ELSS mutual fund, to invest the balance of 88,200 rupees. So we have given you, for an example, both scenarios: term insurance plus PPF, term insurance plus ELSS, to show you how a low risk product and a risk oriented product can perform compared to Tata policy. In ELSS fund, capital gains tax is applied at the time of redemption. So if you have any doubts regarding how the ELSS tax is calculated, we do have a small tabular column presented on the screen for your reference, which you can pause and see. So now the IRR for the term insurance plus PPF combination comes around 6.26 lakhs. So here the maturity value is 26.02 lakhs, and the IRR for the ELSS fund is 10.42% and the maturity value is 48.36 lakhs. So this is calculated on the post-tax return. And if you compare the Tata AIA policies post-tax IRR return to the ELSS and PPF investment vehicle, it makes it clear that the returns provided this policy are not sufficient to consider as a good long-term investment, because ELSS is also a risk-oriented product. But even then, for a long-term period, if you choose to invest in an equity-linked product, it does give us better risk-adjusted returns, because 10.42% is an inflation-beating return, which will give us good value. So what is the final takeaway from this video? Is investing in the Tata AIA value income plan worth or not? This policy provides you with twin benefits of the life insurance cover and regular payouts as you wish. This plan claims to help you achieve your financial goals, but in reality, this plan is a participating endowment policy where the returns are not guaranteed. Moreover, the sum assured is very meager to take care of your family in case of any eventuality. It is always better to invest separately in order to accumulate a corpus for your life goals and to have an adequate life cover to protect your loved ones. Depending on your risk appetite and investment horizon, choose an investment vehicle, plan your investment portfolio to give an inflation-beating return.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.